Live from the City of London for our audience worldwide, equities at session lows. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Coming up, Microsoft are raising gains as cloud sales are set to slow. Better news out of Europe as the German outlook improves. And a top Fed official in line to run Biden's Economic Council. We begin with the big issue, headwinds growing in Silicon Valley.
The big thing for this week is really tech earnings.
For the big tech stocks.
Big tech, we saw the start of it last night.
The message we're getting from this particular sector is that growth is slowing.
Microsoft talked about that last night.
Microsoft is talking about a weak global backdrop.
They haven't guided in this release, so we need to hear guidance.
The cost cuts can only get you so far.
No one was going to do backflips over these numbers.
It's all the other companies that have yet to report that have to deliver bad news.
But relative to the fear, way better than expected.
We're continuing this process of reevaluating valuations.
Some of the tech names, have become a lot cheaper than they were.
But I'm not sure that that's going to continue.
The multiples there are still too high.
Let's not break out the champagne glasses at this point.
Joining us now to discuss is Nuveen Sarah Malik and Keith Lerner of Truist. Sarah Malik, I want to come straight to you with a line from Julian Emanuel of Evercore from last week. He said the market's New Year rally has concluded. Sarah, has the market's New Year rally concluded?
I think the market did come into the year pretty optimistic. If you look at valuations, they were pricing in a soft landing, and that's about the best case scenario for this year. Just this week alone, we have two macro issues with the debt ceiling negotiations and PCE as an overhang. But the real issue for the year is earnings, and you're seeing that with Microsoft. Revenue growth going forward is at risk. Revenues are coming in at about 5% year over year this quarter. I think in the face of a slowing consumer and manufacturing data, revenue growth has a hard time holding up overall, and that means earnings have downside for 2023.
A shout out to Guggenheim, who are on top of this story with Microsoft over the last couple of weeks. Just a few weeks ago, giving the stock its first sell rating in more than 3 years and saying the following: while most investors see Microsoft as a large, stable business that can weather any storm, it does have vulnerabilities, some of which could be exacerbated by this macro slowdown. I want to come to you on that, Keith. You like US large caps. What do you make of that, though?
Well, we're in agreement. We've been underweight the technology sector for most of last year, and we remain underweight. Jonathan, if you think about it, first of all, the rally this year really is just a bounce back from the sell-off in December. On the S&P 500, we were at 4,100 in mid-December. We're still below that. And to go with tech specifically, people have to remember, if you zoom out, over the last 10 years, this sector has outperformed, especially the FANGs, but they were up about 600, 700%, so almost triple the overall market. And then if you think about what happened during the pandemic, the pull forward to earnings was really concentrated in tech. So it's not a surprise that there's an overhang there. And we think as we move into the next cycle, we don't think that tech is likely to be the leadership. And as mentioned earlier, the sector is still trading at more than a 20% premium. So we remain defensive in that area.
Keith, where do you see leadership emerging?
It's funny you mentioned that. I was on a Bloomberg podcast last week, and we would say, hey, will the real leadership please stand up? Because there's a lack of sector leadership, and that's part of the challenge. The tech sector and the growth sectors are the big part of the overall market, and to make a much headway from here, you need them to participate. And in our view, the upside is somewhat capped. So where are we looking at below the market surface, Jonathan? We've talked about this over the last year. We've been pounding the table on the equal-weighted S&P. The average stock in the market is looking a lot better than the overall market, which is being dragged down by tech. That index just made a fresh relative high to the overall market. We would stick with that as far as relative opportunity. But overall, in our portfolio, is still remaining somewhat defensive.
Sarah, what's your take on that?
I agree in the sense two areas I like in equities, and that's defensive and quality. So not necessarily a sector, but areas like dividend growers, companies with lower volatility, some income component. They're more defensive, growing their fundamentals, but also providing a growing income. These are areas that should be more resilient in this economy, and then go outside of equities. I think you can get equity like historical returns and fixed income, again, focusing on quality, investment grade fixed income. A lot of the pain of rate hikes is priced into the fixed income markets, and the total returns to us look pretty promising.
I'll pick up on that fixed income story in just a moment. 25 minutes, 26 minutes away from the opening bell. Equities are lower by more than 1% on the S&P. On the Nasdaq 100, down by 1.7%. Tech earnings throwing cold water on recent gains. Microsoft and Texas Instruments delivering the same message. More pain ahead. Ed Ludlow joins us on the West Coast with more. Morning, Ed.
Yeah, good morning. Both stocks pushing lower in early trading. Microsoft's interesting because it originally rose on the commentary around Azure and its cloud business, and then it fell on that more granular commentary on the earnings call about its cloud business. Amy Hood, the CFO, saying from the fiscal second quarter to the current period, we'll see a drop of about 4 to 5 points in terms of that growth at the cloud unit. But the point was, despite performance in the quarter just gone, the world is changing and that commercial business is softening. Similar picture for Texas Instruments, right? Slightly above or in line with expectations in the quarter just gone, but a pretty tepid forecast. A range where the midpoint wasn't really in line with what the street was looking for. If there was a bright spot from Texas Instruments, which is one of these chip makers that makes the more basic analog and embedded processing units, it's that they did say they saw more weakness in all of their end markets apart from automotive. And I think the street was waiting for Texas Instruments to see if that automotive segment too would slow down. Both companies fit the narrative now that going forward, would we continue to see revisions downwards in earnings expectations for this technology sector? Remember last week, John, we were talking about how going into the first 3 months of 2023, we thought we might be coming out of a sort of earnings trough for the technology sector. But remember, broadly speaking, consensus is for information technology stocks to see EPS drop by around 8% from the same period a year ago. What changes that? Not a lot, it seems. It seems like we're on a downward path right now.
They seem to be very transparent about that, Ed. The leadership of companies like Microsoft. I think Satya Nadella's been pretty transparent, hasn't he?
Yeah, I mean, relatively so. I mean, guiding quarter to quarter is one thing. We didn't really sort of get that full year guidance, although looking at some of the headlines that crossed the Bloomberg terminal during that earnings call, growth to slow in the commercial business for the rest of the full year was the kind of headline that jumped out at me, in lieu of sort of specific full-year guidance, which in Texas Instruments' case, by the way, they don't tend to give full-year guidance anyway, but the street was looking for sort of confirmation that in Texas's case, their full-year sales would drop by 8% as well. So the commentary, the color, matches the math that the street seems to be doing.
Ed, great to catch up. We'll touch base a little bit later in the hour as we talk Tesla. Back with us, Sarah Malik, Keith Lerner. Keith, I want to come to you. Keith, we're up by what, 8% or something like that on the Nasdaq 100 year to date. Why has tech rallied so hard to start 23?
Well, because it sold off a lot last year. What we saw, Jonathan, in December is we saw really a significant pickup in fund selling, especially the areas of the market that were beat up the most. Think about like the ARK ETF. There's a lot of talk about how that's up 25% year to date, but it's flat since December. So these things just got oversold in tax loss selling. That tax loss selling subsided, and we had a bounce back. And January is a big mean reversion month, especially after you've had a year like last year. But we're skeptical that's new leadership in the market, especially with the Fed continuing to take away some of this liquidity. And the other thing is, the general market. There's a lot of discussion about earnings. In our view, you don't even need to have a negative earnings view to say that the market's risk reward is not that attractive, because you're trading at around a 17.5 multiple for the market. Interest rates are much higher than the long-term average, at least the last 10 years. The market is above average. So just at current forward estimates, but as you hear from Microsoft and other companies, it's asymmetric downside risk. We don't think those estimates are going up. So let's say you go down to 210 or below, the market's actually trading at a higher multiple. And if you look at the 10 years before the pandemic, the highest the multiple got was around 18 to an 18.5. The question I would ask is, do you deserve an above average premium in this market when you have above average risk? Our answer is no.
You mentioned the risk-reward proposition. We're told the risk-reward proposition is better this year in fixed income from this starting point. Sarah, you mentioned that. Walk me through the argument for fixed income. And can you tell me how far you're willing to take this when a company like Citi has come out in the last 24 hours and said, buy triple Cs?
Well, first of all, going back to last year, the typical 60-40 diversified equity fixed income portfolio did not work well at all. I think that correlation is much more in investors' favor this year. Just looking at rate hikes going forward, about 50 more basis points expected from the Fed. So that's starting to move behind us. You can start to increase some of your duration in fixed income and get strong total returns in it, as Keith mentioned, without a lot of these heavy macro risks that are going to hit equity. So earnings risk in some of these other areas, the consumer slowdown and that impact on revenue growth and all of that with equities considering their valuations is less attractive. So it goes back to risk reward in fixed income, much lower risk for much higher reward. I'm on the quality side. I think going into a recession, you want to focus on companies with strong balance sheets that can cover their debt service. So quality fixed income like investment grade. There are some interesting areas of high yield though, because energy is a big component of high yield fixed income, and energy companies should continue to have strong fundamentals.
So on the other side of this, Keith, I can see here that you've downgraded high yield, investment grade, and leveraged loans. Keith, why?
Well, because we don't think they're embedding much risk of a recession, not even much of a slowdown. And we went to an overweight to fixed income at the end of October when the interest rates were around 4% and we went long duration. And that's worked out pretty well. But our main message this year is keep fixed income simple. Stick with high quality. Look at high yield spreads. They're back to where they were in the middle of last year. Look at triple Bs. They've collapsed. So the market right now is pricing in a soft landing, and maybe that is a potential, not our base case, but it's already being priced in. If you have any type of recession risk, you're not even baking in any of that. So we think there's risk of spreads widening later this year. And again, we would keep it simple, and we're barbelling kind of short-term rates, which you look at the 2-year, closer to 4%, with things longer than the 10-year because of that duration would help out if those recession risks start to materialize later in this year, which is our expectation.
Sarah, let's build on that and look at the data as well and compare what we've seen take place in the market compared to what we've seen take place with the economic data. The PMIs in America are sub 50. And in the face of that, high yield spreads are getting tighter. Sarah, can you give me the argument as to why you think the data improves or perhaps it goes the other way? I'm just wondering how that reconciles. That divergence surely can't maintain through the rest of this year.
I think data going forward is at risk. So manufacturing data already showing that it's in contractionary territory. The next two shoes to drop could be the consumer and the labor markets. I think consumer continues to weaken. You're seeing that already with the consumer dipping into their savings rates to keep spending. They're doing that because the employment market is strong and wage inflation is strong. I think when you look at employment markets, they tend to crack right about when a recession starts. So we can't really hang our hats on that strength there. You will see payrolls continue to moderate going forward. That'll eventually unwind the consumer, and that's why this earnings story is so fragile. So that is the overall risk. The economic data continues. Reason being that we've had all of this Fed tightening, and even though the Fed is likely to pause in the near future, the impact of that tightening has not really shown its impact on the economy, and that's what we need to see play out in 2023.
So, Sarah, where does that leave a long in credit in the face of what you expect from the economy?
That depends on your time horizon in the sense that we were also overweight fixed income starting in about the middle to late last year. So if they have had strong returns going forward, but again, where are you getting the best risk reward going forward? You can still get nice long-term returns out of fixed income if you were buying in today, which is why we're not downgrading it. But you do need to be more selective, which is why last year we were overweighting high yield and now we've moved up to investment grade. Just one other area I do want to mention, it's kind of in a real assets equity group, is listed infrastructure. This is a nice recession resilient asset class. The backing of it is waste management and utilities and midstream pipelines. That's an asset class we also really like because it tends to be recession resilient and it had poor performance in 2022.
Sarah Malik, Keith Lerner, sticking with us. We need to pick up on the Europe story as well and the international rally. Equities right now down more than 1% on the S&P 500, on the Nasdaq down by 1.6%. Microsoft taking a dive. It's the turn of Tesla with earnings a little bit later after the close. Coming up, fresh data out of Europe continuing to ease recession fears.
Companies are telling us they are optimistic regarding the next 6 months, and that suggests overall we will avoid a technical recession.
That conversation up next.
The most important risk for the German economy was a gas rationing scenario. That risk is off the table now due to the mild weather. Gas storage is full. Companies are telling us they are optimistic regarding the next 6 months, and that suggests overall we will avoid a technical recession. We still expect a shrinking economy in the first quarter, but then an improvement towards the summer.
Things are looking up for Germany. The latest IFO survey showing 4 straight months of improvement in business expectations, with recession looking increasingly likely to be averted. Guy Johnson's been following this story. Guy, talk to me about the data. It's getting better and better.
It's still not great, though, is it? So I think you just need to stand back and look at this number in isolation. Yes, the direction of travel is more positive, but we were pricing in a horrible scenario. Europe was going to grind to a halt. There was going to be rationing. It was going to be really, really bad. So I think we priced some of that out. And Fuss was talking about that. He thinks we avoid a technical recession. It's still going to be difficult. So we've kind of priced out the worst case scenario, but we seem to have gone from worst case scenario to we're off to the races again. And we seem to have gone and done that very, very quickly. And a lot of people are now beginning to question that. So Emmanuel Cow over at Barclays is talking about the European rally, the equity rally having been driven by short covering. He doesn't think retail, he doesn't think sort of larger pension funds are participating in this. So I think we need to take everything that is happening right now, maybe with a pinch of salt.
I asked that question of Patrick Armstrong of Plurimi, who was short the DAX. He said that was painful. He took that short off. And I asked him pretty directly, I said, do you think that's what's taken place? Is this shorts coming off as opposed to longs going on? And for longs to go on, you'd have to believe that we're going to get a real recovery here. Said it a few times, Guy. I'd love your thoughts on this as well. There is a difference between recession and stagnation. We're talking about stagnation. There's a difference between stagnation and expansion. Are we going to get the latter?
Well, the data are pointing to stagnation, aren't they, at the moment? They've gone from being horrible, as I say, to being kind of stagnant. Do they move on to the next phase? And I think that's the big question. But I think the risks are definitely there. I'm going to be speaking to Sebastian Rader a little bit later on from Bank of America. He's the chief European equity strategist over there. His view is that we go down from here in terms of the equity market positions. He sees a significant and aggressive tightening coming through from the ECB, and you're getting that narrative coming through. So that's risk number one. Germany's sending Leopard tanks to Ukraine. If you think that conflict is over, if you think that risk has gone, just look at the front page of all the German newspapers today.
I agree with you. Guy Johnson on the latest. We're going to touch base with Anne-Marie Hordern a little bit later this morning on that story. We'll touch base with Guy a little bit later this morning as well in about 42 minutes' time. Do not miss that conversation with Guy and Alex Steele a little bit later on what's taking place in Europe. Sarah Malik, Keith Lerner back with us. Keith, I want to go to you. The Euro Stoxx 50 year to date is up about 8 or 9%. Emerging market equities year to date up about 8 or 9%. Keith, you don't like either. Why?
Well, we've been big bulls in the U.S. for many years. But I will say you have to acknowledge a couple of things. You know, why has this market turned so quickly? It's because you had a condition of really cheap valuations, you know, very negative sentiment, and then you had 2 outlier events that were unexpected, right? As you just mentioned, you know, there was a lot of discussion that winter is coming. Well, winter never came in the way that people thought for Europe, so that was very beneficial. And so that was the first punch. The second punch that helped out was, you know, China basically ripped the Band-Aid off of COVID. So, you know, Europe's very leveraged to Europe as well, and I think that's helpful. There was a stat, Jonathan, I just saw this week that, you know, in 2019, the amount of tourists from China to Europe was about over 20 million. Sorry, the amount of nights stayed was over 20 million. That moved down to about 1.5 million at the end of 2021. So just think about a lot of these folks that were locked down, you know, traveling to Europe and also, you know, spending on services. So I think that's helped out. So at this point, we're looking at that area closely. You've had a three standard deviation event where EFA has outperformed the U.S. by the most, or one of the most in the last 30 years. So our point of view is I think there is some tailwinds because of you know, you have an opening of China that will help Europe. I do think the long-term structural risks are still there. So we're looking at this point is it's run, waiting for consolidation, and maybe becoming less underweight over time if we get that that kind of pullback. Again, this is more kind of a relative trade since we've been so overweight the U.S. And I think that's what's happening, Jonathan. You see in the fund manager survey last month, the allocation to the U.S. collapsed, and I think you are seeing some asset managers just shift after a 10-year period of underperformance in international.
Sarah, where are you on this issue right now?
I agree with Keith. We came into the year with 3 short-term positives for Europe: the valuation argument, the mild winter, and China reopening. But there's 2 long-term issues we still need to deal with. That's They still have the same inflation problem that the rest of the world has, and their growth, their economic growth is not starting from such a strong level like the U.S. And I think that does put them at the risk of not only not avoiding a technical recession, but even potentially going into a stagflationary environment. So those are the long-term issues, and I think a lot of the positives are priced in. If I was going to play non-U.S., what I'd be looking for is a better entry point for commodities. I think that's a broader play for global growth and non-U.S. growth and China, so you're not just based on Europe. Other thing I like about commodities is that they're a good play into renewable energy. We're going to be producing more renewable energy in the next 5 years than we have in the last 20. So things such as copper, where I expect demand to double by the year 2035. We've been underinvesting in copper. U.S. production is down by half in the last 25 years. That's a very tight industry. I think you could look for a good entry point.
Sarah, do you have a preference on whether it's the underlying commodity or the producer of that commodity?
I mean, I'd be looking at, companies like FCX, which is a producer of copper, looking for companies that have sustainable copper mines that can produce copper in a more resilient, efficient way going forward, and that will feed into that demand, which they continues to strengthen going forward, especially through the next decade plus. Keith, final word.
Well, I think Sarah's point is a good one. We've been more overweight energy, the sector specifically, and also industrials. Think about the increase in defense spending that you're going to continue to see in Europe, even though there's some issues here domestically. I think the defense sector overall is one that should benefit secularly from this strategic battle with China, but also the increase in spending in Europe.
Hey, Keith, great to catch up as always. Same to you, Sarah. Sarah Malik there and Keith Lerner on this market. This market not great this morning, that's for sure. Good morning to you all. Stateside, equity futures negative about 1.1% on the S&P 500. On the Nasdaq, we're down about 1.7%. Microsoft, the big victim after the close, with weak guidance for cloud and cloud revenue. We'll pick up on that story in a couple of minutes' time and push ahead as well to Tesla after the close. Tesla earnings signaling a slowdown ahead, potentially, with the car company cutting prices over the last few weeks. The results continue to roll in with Tesla after the close. That conversation still ahead with Colin Rush of Oppenheimer. Futures near session lows on the S&P. We're down 1%, on the Nasdaq by 1.7%. Let's get you some morning calls. First up, BMO downgrading Microsoft to market perform, seeing limited upside until its cloud business starts growing again. That stock is down 3.5%. Next up, Goldman upgrading Philip Morris to buy, 120 price target, seeing a positive risk reward and improving growth outlook. We're positive there, 1.9%. And finally, Morgan Stanley naming Tesla its top pick in the EV sector, pointing to the company's superior balance sheet, profitability and free cash flow generation. That stock negative going into earnings by 1.7%. Coming up, Tesla earnings on deck. Oppenheimer's Colin Rush expecting mixed results, with competition heating up and margins proving better than feared. Your opening bout just around the corner with stocks down more than 1%. Microsoft went on this market this morning. Good morning to you. Equities down, going into the open by 1.1% on the S&P 500. On the Nasdaq, down by 1.66%. More tech earnings after the close. Looking ahead to Tesla, going into the open. Futures looking soft here on the Russell. We're down 0.8%. There's the opening bout. Switch at the board and get to the bond market. Yields shaping up as follows, going into GDP and jobless claims tomorrow morning. On the 10-year, 354.07, yields unchanged on the 10-year this morning. Euro dollar not doing much off the back of better than expected German business confidence, 108.84 on euro dollar. And crude just about holding on to $80 and about 36 cents, positive there by almost a third of 1%. That's the cross-asset price action about 20 seconds into this one. Equities lower by more than 1% on the S&P, on the Nasdaq down by 1.6. These stocks to watch at the open. It's Microsoft, the company delivering a bit of a grim outlook. The CFO, Amy Hood saying the following: we are seeing customers exercise caution in this environment, and we saw results weaken through December. We expect third quarter growth to decelerate. And Abby, it's that word decelerate that gets our attention.
Yeah, it certainly does. It's getting the stock's attention for sure. And it's interesting, John, because yesterday in the initial reaction to this stock, the report, we had the shares higher on that cloud business. But then as details were given, especially that growth, we now see the shares down, the worst day since January 4th of this year. And you can see here that the last quarter, 38% year over year growth. Initially, investors took that as a good thing, but it's that outlook for this current quarter of 33%. If you take a look at that relative to 48% growth in September of 2021, a 15% deceleration. Now, it's interesting because Satya Nadella, the CEO back last week at Davos, was talking about the idea that there's a normalization out of the pandemic. The question is, what growth number will investors think is acceptable? This, of course, has weighed on revenues overall. We're looking at the slowest revenue growth for Microsoft going back to 2016, growth of just about 2%. Nonetheless, it's not deceleration, so that may be a positive thing. It's not just about revenues, though, John, too. We have an issue around profits. The EBITDA margin slid. It's down more than 7% from its September 2021 levels. So we're seeing some issues there. Technically, the stock, though, John, it's interesting from a long-term perspective, looks as though it could have found some sort of a bottom. We'll, of course, find out. But when you take a look at valuation, 23 times next year, more than 30% bottom line growth for managers who have to own tech. At some point, this may be a stock that they're going to look at. Not exactly a kitchen sink quarter here, but enough bad news may be out of the way that you'll see some folks nibble, maybe even later today, John.
Stock's down 3%, a little bit more than that, about 2 minutes into this. Abby, thank you. Broader market down by 1.2% on the Nasdaq, down by almost 2 percentage points. Texas Instruments delivering a similar script, the chip maker failing to provide investors with any clarity on sales. The CFO had this to say: arms in the air, I wish I knew. Customers have done what they've done for decades. They've built a little too much inventory. We'll see how long that takes to work itself out. For more, here's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, it's no surprise that one of the largest chip makers in the world is feeling the chip slump in a big way. They actually reported their first decline in sales going back to 2020, a decline of about 3.4% for revenue, even though that did come in ahead of expectations. And for the quarter they just reported, profit came in ahead of expectations too. But when it comes to their guidance at the midpoint of the range they gave, both the top and bottom line came up short of analyst expectations. The basics here, John, is that Texas Instruments may have the broadest range of products in the industry and the longest list of customers in the industry, but that doesn't matter so much when those customers aren't demanding as many of those products. Instead of ordering new chips, they're focused on reducing their stockpiles of used ones because they have too much. This is a very common post-pandemic story. So that has led to weaker end demand for Texas Instruments in almost all of its end markets, the exception being automotive, which is about 21% of its revenue share, but everything else, they said, was down between 10 and 20%. One analyst over at BMO this morning said it's only a matter of time before there's weakness in automotive as well. At Citi, they're talking about broadening weakness, saying it appears gross margins could drop another 200 basis points quarter on quarter. What I do find interesting on that point, though, John, is despite those pressures, Texas Instruments executives say they aren't planning to reduce headcount in order to cut costs. The reason why, the CFO says, because the company didn't get ahead of itself and hire a lot of people over the past 2 years. Their headcount has actually stayed remarkably steady, so that is something that differentiates them from the other technology-oriented companies that we are seeing with layoff announcements almost each and every day, John.
That's a bit of shade. Everybody else, it seems, over in tech. Kaylee, as you say, Kaylee, thank you. That stock is down 1.3%. Tesla leading the next round of tech earnings. Those results coming after the closing bell as investors' concerns keep piling up. Ed has more. Hey, Ed.
Yeah, good morning again, Jonathan. Well, we see the stock lower 1.9%. Both JP Morgan and Morgan Stanley cut their price targets on the stock ahead of earnings, basically saying that they're looking at those price cuts, particularly in China, and what that will do, not necessarily as a lever and driver of demand, but what it means for profit going forward. Analysts expect adjusted earnings of $1.12 per share on $24 billion of revenue. That would represent sequential and year-on-year growth, but they go straight to gross margin, right? Tesla is kind of the industry leader when it comes to gross margin, which analysts expect to come in at 25%. What does the impact of those price cuts do to that gross margin? You know, remember Elon Musk has talked quite recently on a Twitter Spaces on the issue of demand. And, I'm paraphrasing, but his question that he posed was, do you want us to demonstrate unit growth and use price cuts as a way to drive volume growth, or do you want to grow slowly and steady? His conclusion would be that Tesla should grow as fast as they can without putting the company at risk. What I would say when it comes to Tesla's quarterly earnings, Zach Kirkhorn, the CFO, tends to step up, give granularity about what Tesla is doing with regards to the supply chain, the management around the bottom line. Sources have been telling me recently, go back to that last quarter of deliveries. Internally, there's still frustration over the number of vehicles that were in transit, therefore not delivered to customers, and therefore not booked as revenue. So that's still an issue we're going to be monitoring for as well.
Just quickly, some clarity. You touched on it a little bit. Are we going to hear from Elon later?
I believe we will. The context here, Jonathan, is that Elon Musk has told investors in the past that he doesn't believe he needs to attend earnings calls and that there are better uses of his time. But following those statements made 18 months ago, he has continued to attend the earnings calls. He has been in San Francisco courthouse, of course, this week around the 2018 Take Tesla Private tweet hearing, which is a jury trial. And he then flew to Nevada 24 hours ago for the announcement of a $3.6 billion expansion of their facilities there. So there's nothing that tells us he won't be on the call, I don't believe.
Looking forward to your coverage a little bit later. Ed, on the West Coast, on top of Tesla. Oppenheimer's Colin Rush looking ahead to Tesla results and saying the following. The core issue is whether the company can continue to grow while maintaining premium margins. We anticipate mixed trading on shares as EV competition begins to play out and expect updated margins to be modestly better than feared. I'm pleased to say that Colin joins us right now. Colin, let's start there. The price cuts, and thank you for being with us, by the way. The price cuts of the last couple of weeks, are they a bigger problem for Tesla or their competition?
I really think this is a proactive move on Tesla's part to make it very difficult for their competition to ramp. They have a structural cost advantage because they've designed cost out of the vehicles, and they've got a volume advantage. We think they're pressing that advantage now to make it pretty painful for competition. And I think the real question for investors right now is what's the normalized margin going forward through 2023? I think the strategy that they're looking at is coherent, and there's a lot of investor concern around competition here. But what the normalized margin and cash flow looks like for this company, through 23 and 24 as we go through this adjustment period of actually having competition for the first time is really the heart of the matter for the stock.
Colin, what do you think it is?
I think it's going to be a little bit better than feared. We think there's some folks betting on, margins being in the low 20s for 2023. I think with the commodity tailwinds, some of the supply chain things that you were just talking about on the program with components becoming more available, plus some of the, the sell-through and utilization on the new factories, point to margins being a little bit better than feared. I'm not sure we're going to get to the street's at 26.5% right now. I'm not sure we're going to get all the way there from a gross margin perspective, but if we're in the 24-25% range, I think the stock rallies from here.
Colin, given what's happened with price, has that changed your view on what you think the growth numbers are going to look like for the time being, going out several years?
I don't know. So there's a lot going on here. I mean, obviously, Elon's brand has taken a big hit with the Twitter acquisition and some of the behavior around that. We downgraded in December around just the rounding error or the incremental customer being a little bit more cautious around buying a Tesla just from a brand perspective, and that can start to shave some of the pricing power that the company has. And so as we look at this, there's certainly demand for EVs. We think there's a very big market. There's an awful lot of consumer interest. The total cost of ownership advantages, both in the U.S. and Europe, are still pretty meaningful, and so we think there's sell-through at the right price. But I think people are being a little bit more cautious with the potential recession. We've got a lot of layoffs and really pretty decent jobs where folks could be looking at a premium vehicle purchase. And so I think this year is an adjustment year. We're going to find out kind of where the levels are as we get into the first half of the year and what this looks like. The other thing to consider is really the China demand. We've gone through a change in the subsidy regime in China. That adjustment is starting to be felt from an inventory perspective. There's also a little bit of a slow start to the year with the Lunar New Year being early and some of the reopening. And so there's some inventory flush that needs to happen on vehicles and batteries in China in the first quarter here. And as we get into the latter part of February and into March, we'll get a better feel for how the year is going to progress in China. And that will matter for Tesla from a unit perspective.
There's also, Colin, the valuation issue as well. Rates have gone to 450 at the Federal Reserve. That makes a monster difference for companies like this. And Colin, I'm just wondering from your perspective, how one should value this company. I know what the bulls think. It's a tech firm. I know what the bears think. It's just another auto company. What do you think?
Yeah, we've been firmly in the tech company camp for a very long time. We think that these guys are cycling technology well in advance of peers. They're innovating on the material side, both at the battery level as well as the vehicle level, structurally on the cars as well as in the powertrain. But additionally, around the perception and the navigation system, we think they've got real significant advantages around miles driven and learning cycles on that. And so we think you deserve a premium multiple here. What we're concerned about is the adjustment of the auto industry and Tesla's place in it and potential distraction for management. What you were talking about, Elon being on the call tonight, we would expect him to be here. I think he needs to show that he's attending to what's going on at Tesla and isn't distracted by a number of other things that he has going on his personal plate. And so I think he'll attend and be very full-throated about the positioning that Tesla's at and how they're approaching the market strategically. And so we think that ultimately there is going to be a premium as we look at where rates end up and what multiples really are appropriate given the interest rate environment. We'll come back to that. Right now we don't have a price target given our perform rating, but we think there is a premium multiple and a tech multiple that is appropriate for this company as we get a better sense of what the earnings power really looks like.
Colin, just finally, there was some chatter about capital returns. What do you think that looks like this year, if at all?
I don't think they're going to do, any sort of dividend, return to investors at this point. There are so many opportunities for them to invest cash. We think that they will take those opportunities to grow the business and accelerate some of the cost reductions within the platform. And at some point, they may think about dividending cash out. But I think there's too many opportunities for them to invest right now to really think legitimately about a dividend.
Colin, this was thoughtful stuff, as always. Colin Rush there of Oppenheimer on Tesla. The numbers coming up after the close. Coming up on this program next, President Biden eyeing a top Fed official to run his economic council.
Policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, United CEO Scott Kirby. That conversation at 11:30 a.m. Eastern, 4:30 p.m. in London. This is Bloomberg.
That said, inflation remains high, and policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
President Biden looking to add the Fed's vice chair to his team. Bloomberg reporting Lael Brainerd is a top contender to become the new head of the National Economic Council. On top of that story, Bloomberg's Anne-Marie down in D.C. AMH, walk us through what you've learned this morning.
Well, John, what we know now is that she is not just in the running, but a top contender, as you mentioned, to take on the job of the director of the National Economic Council. We should note no decisions have been made, and there are other names that have been thrown around, like Gene Sperling, like Wally Adeyemo. But right now, what you potentially could see in the coming weeks is that the Fed's #2 becomes the #1 economic voice in the West Wing. This is on top of a little bit of a shakeup at the White House, which is pretty much natural when you have, after a midterm election and 2 years of an administration. We do know that Ron Klain will also be exiting, and as well as Brian Deese. And that's why Lael Brainerd's name is getting a lot of attention this morning. But Jonathan, no one is walking out the door before the State of the Union on February 7th.
MH, great reporting, as always, on the ground down in Washington, D.C. I just want to squeeze this in, Anne-Marie, just briefly if we can. It's an important question about the tanks that Ukraine is finally receiving. Anne-Marie, your view on that. Is that an escalation? 6 months ago, would this have happened?
It would not happen 6 months ago, but when you talk to the Ukrainians, and I recently talked to an official that advises the defense ministry, he says that this has always been the way it was working with the West. They would drag their feet in their words, but then they would come to the realization that this is what is needed on the ground. And for Germany to act, they're acting alongside the United States. Russia will move any move as an escalation. But if they're going to act together, Germany feels much more comfortable sending those Leopards, and the U.S. will be sending their tanks as well.
Anne-Marie, great work down in D.C. Joining us now is DWS Group's Greg Staples. Greg, I just want to touch on the story that AMH went through a little bit earlier on the vice chair of the Federal Reserve in line to move towards the administration. No idea if that actually materialises or not, Greg. Would that leave a big hole on the Federal Reserve board for you?
I think it would leave a little bit of a hole. I think, of course, what's going on right now is you float a lot of names and you get some sort of political reaction. I think it's the reaction to the floating of names that ultimately determines whether Lyle Brainerd or Gene Sperling or somebody else takes that role. It's a bit of a strange step for her. I'm surprised that they're doing it, but I think the Fed would manage. There's certainly a lot of qualified candidates that could take that spot if she decided to move.
Let's pick up on the commentary of Lyle Brainerd, the Fed Vice Chair. She's talking about the cumulative tightening, the bill, so to speak, for the tightening that's already in the pie. Can we talk about that just a little bit? There's two competing forces right now, Greg. On the one side, you've got sub-50 PMIs. On the other side, you've got jobless claims of 190,000. What do you put more weight on?
Right now, I think we probably put the weight on the jobless claims. I mean, ultimately, there's really a lot of consensus about where we end up, say, in 2024. Both the Summary of Economics projections and the forward markets are saying we're going to get Fed funds down to 3%. It's really just a battle about the trajectory, whether that happens with a pivot beginning in June, July, or the Fed's put a lot of credibility on saying they're not going to do that until 2024. We're a believer more in the Fed, thinking that they'd like to get to 4 3/4 to 5, do that perhaps in the March meeting. May is still open, and then really sit tight for 2 or 3 quarters. They've put a lot of credibility on the line on that, and I think they have to push it through.
Just on the labour market, you said don't confuse tech layoffs with softer labour markets. Why is that, Greg?
There's still a lot of demand, I think, in the Main Street part of America, whether it be services, your barbers, your garbage collectors, your landscape people. Corporate America is obviously laying off, but it's been limited so far. I think a lot of the tech workers are going to be able to find jobs elsewhere. And I also think that it's really hitting the bottom now, that corporate America has really been very well prepared for this recession. This is the most well-signaled recession we've ever had, if indeed we have it. This is the first time we've actually had a recovery in the markets before the recession that seems to be associated with it has even begun. So I think there's limited downside to that degree. I think corporate is still hoarding their workers to some degree. So I don't see a lot of downside in terms of the labor markets, at least over the next 3 to 6 months.
With that in mind, Greg, shouldn't you be super long the credit market?
We're fairly comfortable with the credit market overall, as strange as that sounds. Things have richened a lot since the beginning of the year. We're in 20 to 25 basis points in IG, over 100 since October, and a high yield. They're pretty much priced the way they've been on average over the past 10 years. We don't see the kind of recession that's going to really gap out spreads overall. We've seen a lot of strength within the past month or so, and think that will probably continue. It goes back to what I was saying before. Corporate America, their financial health is quite strong. We're going to see a little bit of caution in the guidance as we see earnings coming through over the next week or 2 or 3, but nobody's signaling a deep recession, and I think they're quite well prepared for the storm if indeed it comes.
Can I finish with this call from Citi in the last 24 hours, Greg, and get your reaction to it? Citigroup said this, the Triple C spree, that was the title of this note. We flip our rating for regular weight Triple Cs to overweight due to light investor positioning, loosening financial conditions, and the shifting composition of the segment away from cyclical sectors. Greg, how do you react to that?
I tend to agree. I think the Triple Cs have had a remarkable rally since the beginning of the year. I think a lot of it's just a risk grab. If you need to get risk in the high yield space, of course, that's where you want to go. But that area, I think, is the one that's going to be most vulnerable if indeed we get some slowing. Obviously, increase in interest rates for floating rate debt is going to cause some problems there. It's really not going to be, I would call, broadly across the Triple Cs. It's more idiosyncratic, but there are going to be some names that are going to suffer, and you have to really pick your spots very, very carefully within that very vulnerable space.
Greg Staples at DWS, the first couple of weeks felt like a risk grab. Not right now. Greg, thank you. Right now, about 22 minutes into this session, we're lower by 1.2% on the S&P and the Nasdaq. We're down by 1.8%. To lift the lid on the index, to get you some sector price action, here's Abby.
Hey, John. Well, yes, it's certainly a down day here. That S&P 500, as you mentioned, down 1.2% on above average volume, too, suggesting the sellers right now are serious about their selling. Up top, we have healthcare, defensive sector outperforming, staples up there as well. On bottom, though, not surprisingly, it's all about technology. Microsoft right now near session lows, down 4%. Technology, therefore, is down 2%. Some of the other big techs, such as Apple, Amazon, Google, Tesla, selling off in sympathy with that quarter and that cloud guide. We also have Texas Instruments near session lows, down 2%, dragging. Let's stick with the chips, because, of course, we have this huge rally for the chips out of what could be an October low, up more than 40%. But over the last year or so, John, 13 months, down 29%. The question is that sideways trend that is developing. That's a real battle between the bulls and the bears. As for what's ahead, what direction will it break? Up or down? We don't know yet. But right now, we do have the stocks down with the broader markets.
The broader markets right now down 2, as you indicate, Abby. Thank you. We're down by 1.2% on the S&P, and the Nasdaq down by about 2 percentage points. Up next on this program, your trading diary. Not a fantastic start to the morning, that's for sure. For the equity bulls, at least. On the S&P, we're down by 1.3%. On the Nasdaq, we're down by more than 2 percentage points. Microsoft helping to lead the losses here, in the early part of the session at least. Let's get the trading diary for you. A rate decision from the Bank of Canada coming up at the top of the hour. President Biden discussing support for Ukraine at noon Eastern. Look out for that. Plus earnings from Tesla and IBM after the close. US fourth quarter GDP and another round of jobless claims coming up on Thursday. And finally, PCE numbers and the UMich sentiment survey to round out the week on Friday. From the City of London, that does it for me. For our audience worldwide, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.